The markets just triggered a death cross. That's when the 50-day moving average crosses below the 200-day. And in a shaky market like this, that's not something you should ignore. Back in 2022, we dropped 15%, had a quick bounce, and then boom, the death cross hit. That was the start of a full-on bear market. We dropped another 20% right after that. Retail traders got absolutely slaughtered, while institutions, they didn't just survive, they feasted on the volatility. And now we're seeing the same setup, the same signs. This doesn't look like a bottom. It looks like the start of another flash. Let's jump in. And real quick, before we dive into the rest of the recap, happy Easter to everyone celebrating. Hope you're getting some rest before markets reopen. We've got a lot to cover this week. Here's the plan for today. We'll cover the key macro headlines that moved the markets this week. Powell's comments, the tariff jump, and Bill Ackman's unexpected 20% stake in Hertz. Then we'll break down insider activity and option flows that line up almost perfectly with the NVIDIA and Tesla news. Some of the timing here is worth paying attention to. After that, I'll walk you through the technicals, especially the death cross, and how the charts are matching up with broader market risk. And to wrap it up, we'll look at the most important economic data and upcoming earnings, including Tesla, so you're fully prepared heading into next week. Alright, let's get into what actually happened this week. The market just triggered a death cross, and while that doesn't mean everything falls apart overnight, it's usually a warning sign that things could get a lot worse before they get better, especially when it shows up alongside the kind of news and moves we got this week. On Monday, Apple and NVIDIA gapped higher, lifting the markets with them on hopes that semis, phones, and computers might be exempt from the tariffs. But later, it was confirmed that the tariffs weren't being cut, they're just not being enforced yet. Instead, they'll likely go into effect in a month or so, and rather than facing the full 145% rate, this could get a special pass at 20%. That added more uncertainty, which the markets didn't like. China also retaliated, halting exports of rare earth minerals and magnets into the US. These are essential inputs for semiconductors, aerospace components, and EV batteries, which made the markets even more volatile. Trump did try to counter the uncertainty, promising the permits would be fast-tracked for US companies investing domestically, specifically pointing out at NVIDIA's $500 billion AI infrastructure plan. It helped slow the bleed, but it didn't reverse the tape. Risk appetite stayed soft going into Tuesday. Tuesday started off slow, but options flow told a different story. NVIDIA calls were being dumped early, and by mid-afternoon we saw a huge spike in short-dated QQQ puts, more than $400,000 worth. That kind of flow usually means someone knows something, and they did. After the close, it was announced that NVIDIA's H20 chips would now require US export licenses to be shipped to China. NVIDIA estimates this could hit their Q1 revenue by over $5.5 billion. The stock fell more than 7% in after-hours trading. That massive shift in options flow earlier in the day, now it suddenly made a lot more sense. This wasn't the first time we've seen this pattern. Big put activity right before major headlines. Retail traders are starting to ask the same question: is this a coincidence or something else? We'll actually get to this soon. Wednesday kicked off with Trump raising tariffs on Chinese imports to 245%. A major escalation that sent another wave of risk-off sentiment through the market. Then Powell spoke. He warned that these new tariffs could reignite inflation, and he made it clear the Fed isn't stepping in to support markets. No rate cuts, no Fed put. You're on your own. Later that day, we got another surprise. It was revealed that Bill Ackman had been quietly accumulating shares of Hertz since December. He now owns nearly 20% of the company. And the best part? Hertz has a short float over 40%, meaning a large percentage of its shares are borrowed and sold short, betting the price will drop. When a stock like that starts running, shorts can be forced to cover, which can accelerate the move even more. The stock doubled this week, moving from $4 to nearly $9. If that short squeeze gains momentum, things could get really wild. And again, the theme continues: big players always a step ahead of everyone. By Thursday, attention shifted to healthcare, and it wasn't good. United Health missed earnings and slashed its 2025 earnings per share guidance from $30 down to $26. That's a big revision. The stock dropped nearly 25%, dragging the Dow Jones down more than 1.5%. This wasn't just a United Health issue either. Other managed care names like Elevance and Humana sold off in sympathy. It triggered a broader pullback across the healthcare space. The weakness extended beyond healthcare. Traders stayed defensive, and there was little interest in adding risk. At the same time, we saw heavy dumping of Tesla call options. Then, just minutes before the close, large flows came in targeting Tesla puts. That kind of shift usually means someone expects something to happen soon. And on Friday, Tesla officially confirmed what the flow was hinting at. It's delaying the rollout of its affordable EVs and lower-cost Model Y in the US. They blamed it on tariffs, aging models, and production issues. This came right after Thursday's heavy call dumping and a wave of Tesla put buying just minutes before the close. The timing lined up perfectly. This clip of Trump resurfaced again.
And he made $2.5 billion today, and he made $900 million. That's not bad.
It was originally from April 9th, the day he announced the 90-day tariff pause. Turns out the room was filled with billionaires. One of the people there later was confirmed to be Charles Schwab. Looking back now, it's hard to ignore how many of them were already positioned before the rest of the world even got the news. And it's not just Tesla. NVIDIA saw the same thing. This pattern is repeating. Big trades showing up right before headlines. Meanwhile, retail is left holding the bag. To make it worse, retail traders just piled $6.6 billion into leveraged long ETFs, the highest in years. While insiders are quietly scaling out or hedging, retail just keeps piling in. This doesn't look like one-off bad week. It looks like another wealth transfer from retail to the ultra-rich. This is why I'm sharing all this with you, so you're aware of what's happening in real time. That's why I've been pushing caution and hedging to make sure you don't end up like the rest of the ship getting blindsided. Now let's break down the chart so you know exactly what I'm watching, what levels matter, and how I'm positioning going into next week. Starting with the SPY, on the hourly chart, we've been making lower lows and lower highs all week, a classic downtrend. Friday was the only day where we didn't make a lower low, but overall we're making a bear flag pattern. If that breaks down, we're heading lower next week. If we zoom out, you can also notice we're making a symmetrical triangle. This type of setup doesn't give a clear direction. We'll just have to react to whichever way it breaks. On the daily chart, you can see that triangle even more clearly. We also fell short of filling the gap around 556 and 61 cents, which lines up with the 5,500 to 5,600 range on futures, an area where bears have been waiting to sell into strength. I mentioned this in last week's recap as a key level that could act as a ceiling, and it played out exactly like that. We did catch a support at 9-day moving average, but without any positive headlines like tariff resolution or strong earnings, the risk stays tilted to the downside. I think what this pattern is trying to tell us is there's clear indecision in the markets right now. Traders don't have conviction. No one's confident enough to go full risk on without a solid catalyst. But they're also not pulling the plug without confirmation either. That back and forth is keeping the price stuck. And unless we get something to tip the scales, we're likely to drift lower. Personally, I'm holding longer dated puts in case we roll over. And I've hedged with some short dated rebound trades. Some of those didn't work out exactly as I planned, like Apple and NVIDIA. I'm also holding shorter dated puts that expired next week to hedge my long exposure. So this week will be important for how I manage that risk. Make sure you're following me on Twitter for live updates throughout the week. Now, let's address the elephant in the room, the death cross. That's when the 50-day moving average crosses below the 200-day moving average. You can see I just highlighted this in yellow. Historically, when this shows up in a shaky market, especially after a bounce, it tends to signal more downside ahead. Back in 2022, we saw the same exact setup. Markets dropped about 15%, then gave a little bounce, and right after that, boom, we got the death cross. What followed was another 20% drawdown. That death cross was what officially marked the start of the bear market. So based on everything we've talked about so far, earnings risk, macro headwinds, insider flow, this isn't something to ignore. If we get more bad news or no resolution on tariffs, or if earnings come in weak, this pattern could trigger a much bigger move to the downside. This is exactly why I've been saying you need to have longer dated puts. These are what have been protecting me in this volatile environment, and should be your base protection if we do get more downside. You can still use shorter dated calls to hedge against short-term rebounds, but the broader setup is pointing lower, and you want to make sure you're covered if that plays out. If we lose the 9-day moving average and the 518.50 level on the daily, we will likely retest the previous lows around the 490. And if that doesn't hold, we're talking about a break towards the 478.57, which lines up with the 200-week moving average on the weekly chart. That would be a major level of support. I'll be watching that closely and posting updates on Twitter, so make sure you're following me there in case we start moving fast. The daily chart of S&P futures looks even weaker. We got rejected at 5,508.50 cents and have been trending in a descending triangle since then. This usually breaks lower. A daily close below both the 9-day and the 5,300 confirms we're likely retesting the lows. 5,300 has been my line in descent. If we start trading below that level, I'm closing out the rest of my calls and I'm leaning fully into the downside setups. It's a key pivot that's held us up before, but if it breaks, that confirms the sellers are in full control. We also saw a death cross in the futures as well, which only adds more weight to the bear case. These setups don't mean we crash instantly, but more often than not, they lead to deeper downside, especially when momentum is already rolling over. At this point, unless Trump administration completely reverses its stance on tariffs and walks everything back like nothing happened, I think we're heading straight into a bear market for 2025. You have to be both mentally and financially prepared for that possibility. Like I mentioned earlier in the recap, retail keeps trying to buy every dip, but every rip has just turned into another dead cat bounce. And as this plays out further, it's only getting uglier for them. The sheep are getting slaughtered, while the ultra wealthy are getting in early, hedging properly, and walking away with profits. Meanwhile, retail just keeps getting sucked into this hype and ends up holding the bag. It's the same story over and over. A wealth transfer happening in real time, right in front of our eyes. The daily chart of the triple Qs is showing the same formation we've been seeing in the S&P. Lower highs, lower lows, a clean descending pattern. Same story is for NASDAQ futures. That's why I'm not gonna go to overcomplicate this section with new scenarios. The levels, the structure, the weakness, it's all tracking in line with SPY and S&P futures. We also now have a confirmed death cross on both the triple Qs and the NASDAQ futures. This just adds more weight to the downside setup. If SPY breaks support, triple Qs will follow. So I'm showing you my levels highlighted on the charts for both, but I'm not going to repeat the same scenarios I already laid out earlier. The risk-reward setup and expectations are identical. These charts are basically moving as one. VIX has closed below the $30 on Friday. That is a good sign if you're bullish in the markets. But it closed right on top of the 20-day moving average. I wouldn't say we're out of the woods yet. This could just be another A, B, C pattern, and we head higher to test the previous highs around $60. But if we do close below the 20-day moving average, then I will have more confidence to say that for the time being, we're cooling off and markets should stabilize and start heading higher. I also want to point out two daily gaps we have on VIX. One is at 37.50 and another lower around 22.40. The question is which one will get filled first. Both seem to be equal distance away from where we closed on Friday. Notice how much indecision there is in the markets. Across all indicators, we can see traders and investors are not really sure what to do. And this further proves my point that they're just waiting for a resolution with the tariffs or any good earnings which will give some hope to push the markets higher. Otherwise, we will see panic coming back again. The daily chart of IWM, we are holding the 9-day moving average as well as the 183 and 36 support level. The MACD also switched bullish. Seems like there is some life coming back to the small caps. We have a gap near the 196 and 70 level. If we see risk on rotation, IWM will head higher to close that gap. If, however, we end up losing the 9-day moving average and close below 179 and 65, then I expect a retest of the previous lows near the 170 zone. Now let's talk about NVIDIA. We got some bad news over the week that completely ruined the uptrend we had going on. On the hourly chart, we tested the 100 support multiple times and we are still holding it. If we lose this level, I think that will be it for NVIDIA. It can flash down to another 10 to 20% at minimum. There are many buyers sitting near the $70 to $80 and waiting to buy the stock if the price gets there. So that level should still provide some support. However, the thing that worries me right now is Friday's price action. On Friday, notice how we made another bear flag pattern. And unless we get some good news or a resolution to this whole tariff mess, that pattern probably breaks down and the 100 level won't hold. On the daily, notice we've been trading in a downtrend since 2025 started, and we've been making lower highs and lower lows. Right now, that pattern hasn't been broken yet, and MACD is about to turn to bearish, providing further confirmation of the weakness. That means the risk is to the downside, and the expectation is NVDA is going to break below the previous lows. That will take us down to 75 to 80 range, where we should see more buyers showing up, as I mentioned earlier. If you're bullish on the stock, you want to see NVIDIA take out the previous high near the 114.77 cents. If we start trading and closing above this level on the daily, that means the descending trend pattern has been broken. Looking at the daily chart of Tesla, nothing really changed since last week as far as the technicals go. We're still consolidating between this wide range of 218 and 280. We have multiple catalysts going into next week. First one is the delay of the rollout of its affordable EVs and lower cost Model Y in the US. We also discussed big whales piling into Tesla puts before this announcement was made. Second, we have the earnings report coming out on Tuesday. This is going to be the biggest driver this week in my opinion. The strategy is still unchanged for me. I'm sitting on the sidelines and waiting for a breakout either above the 200-day moving average, which will be bullish, or below the 218 support level, which will open the door of heading lower towards the 200, then 180. My bias is still bearish on Tesla, but I don't plan on gambling prior the earnings report. I will react once that's out and we get a clear directional trend established with Tesla. Apple's daily chart is also showing weakness. The good news during last weekend sent Apple gapping higher on Monday, but the strength was sold off throughout the day and the week. There is still a lot of uncertainty with China, and unless we get more clear confirmation as to what the final plan is, we can see more volatility with Apple. From the technical point, we got rejected from the 20-day moving average. Right now, we're holding the 192.94 level, which also corresponds to the 9-day moving average. The MACD is bullish, but it's showing weakness and can flip back to bearish at any moment if we have another big drop. I'm positioned in some rebound plays on Apple by next Friday, but I also have put spreads at 200 and 195. The puts should negate any losses I will have from the long positions. Remember, make sure you're always hedged, especially in this type of market. Looking at the daily chart of crude oil, we see some strength. We retook the 61 and 55 level, and the MACD is also showing signs of reversing into bullish momentum. The line in the sand is $66. If we retake this level, then that is bullish and we should start seeing oil heading higher. But if we head back and lose the 61 and 55, then we will be heading lower towards previous lows. That will signal recession fears and will impact the markets negatively as well. The US dollar is forming a bear flag pattern on the daily chart. This is really negative and means that investors are fleeing the US dollar into other currencies, as well as gold. We need to see a resolution to this uncertainty if we expect to see a rebound in the dollar. A break below the previous low of 99 will most likely send us down towards 97.761. As of recording this video, we are currently trading below the support level of 99.318. Looking at the 2-year yield, it closed below the resistance of 3.844%, and the MACD on the daily is curling down, about to shift into bearish momentum. If this happens, then expect to see lower yields. A retake of this level will most likely signal that we will head higher and retest the 4% level. The 20-year is showing a formation of a bull flag pattern, meaning we can see a retest of the previous highs. On Friday, we closed slightly above my level of 4.836%, but it's not a solid close where I can confidently say we will head higher. The MACD is slowly shifting from bullish to bearish momentum. If we see a confirmation, that's when you know the 20-year yield should cool down. But as of right now, I will say the risk is to the upside, which means we will see a flash in TLT, which further supports the bear flag we saw in TLT. Folks, if we see that happening, in addition, if we see the financial risk heading higher, we will get another flash down in the markets. Make sure you're protected and make sure you're writing down all the levels, scenarios, and strategies I'm sharing with you. This type of detailed market breakdowns are usually behind paid walls for many traders and investors. Yet, I'm giving this out for free. So make sure you capitalize on it. Technicals out of the way, let's take a look at next week's important reports and earnings which will drive the markets. Starting with Monday, we have US leading indicators. This is not a major market mover, but weak results confirm slowing growth and push traders towards defensive plays. On Tuesday, we have multiple Fed speakers. Any shift in tone from these comments can impact rate expectations and move markets, especially bond and tech. On Wednesday, we have Flash PMI, new home sales, and Fed Beige Book. The Flash PMI is an early read on services and manufacturing activity. Weak numbers add to slow down fears. New home sales measure demand for newly built homes, useful for gauging housing strength and consumer sentiment. Beige Book is Fed's regional economic summary, often provides early hints of potential shifts in policy stance. Thursday, we have durable goods, existing home sales, and jobless claims. Durable goods orders track business investment. Strong results can raise concerns about inflation. Existing home sales reflect current housing market activity. Higher sales indicate stable demand despite rate pressures. Jobless claims provide a quick snapshot of the labor market. Rising claims can build the case for rate cuts. And finally, Friday, we have final consumer sentiment. It gauges how confident consumers feel about the economy and their finances. Given the nature of how things have been unfolding lately, this could be a big market driver. Finally, let's take a look at the key earnings for next week. On Monday, I don't see anything major, but on Tuesday, we have Tesla, GE Aerospace, Lockheed Martin, Verizon, Capital One, and 11th Health. Tesla is gonna be a big one, so make sure you're properly hedged. On Wednesday, we have Boeing, IBM, AT&T, Chipotle, ServiceNow, Texas Instruments, Lam Research, Sands Las Vegas, Newmont, Alaska Airlines, and many more. This will be an important day. Thursday, we have Intel, Alphabet, Pepsi, T-Mobile, Merck, Valero, American Airlines, and much more. Another big day. And finally, on Friday, we have AbbVie and some other big names. Again, earnings from Tesla and the semis will be especially important after the kind of volatility we saw this past week. Watch how names like Texas Instruments and Intel move post-earning. They could shift sentiment really fast. And obviously, it goes without saying, if you own any of those stocks in your portfolio, make sure you've protected against wild swings if the earnings come out disappointing and we see a flash in those names. To summarize this video, this week was another roller coaster. More flip-flops from the White House, more conflicting headlines, and even more uncertainty hanging over the markets. We got a death cross confirmed in the markets. NVIDIA said the export license rules could hit their revenue by over $5.5 billion every quarter. Tesla confirmed delays, and retail? Well, they've been loading up on leveraged loans while insiders are quietly hedging or stepping out completely. We've seen this before. Right before every other big move lower, retail gets sucked in thinking it's the bottom, and the whales already have their exit strategy. This is how wealth transfers happen right in front of us. Same playbook, just a different year. If you've been getting value from those breakdowns, do me a favor, like and subscribe. It helps the algorithm push this out to more traders who actually need this kind of info. Also, if you want all my weekly notes, pre-market plans, and setups right into your inbox before the bell, then make sure you're on the newsletter. It's free and the link is in the description below. And of course, follow me on Twitter for live updates and midweek breakdowns. Thanks for watching, and I'll see you in the next one.